Welcome to Talk Tickers. Today we are digging into Dominion Energy's Q4 2025 earnings, and folks, this is a really interesting one. It's a classic case of a company putting up solid numbers, but the market, well, the market had a completely different reaction.
Okay, so here's how we're going to break it all down. First, we'll look at that weird paradox between the results and the stock reaction. Then, we'll get into the nitty-gritty of the numbers, the beat and the miss. After that, we'll unpack management's massive $65 billion growth plan, but also cover the near-term headwinds that have the market so spooked. And finally, we'll wrap it all up with our verdict, the next call.
All right, let's start with this paradox. On paper, this quarter looked pretty good for Dominion. But if you just looked at the stock chart, you'd think it was a total disaster.
And this really gets to the heart of it. You had management on the call painting this incredible picture of long-term AI-driven growth. It sounded fantastic. But traders, they were hearing something else entirely and just hitting the sell button. A total disconnect.
And here's the result in plain numbers. The stock dropped over 2.6% on the day of the call, and on heavy volume too. It basically erased all the nice gains the stock had made recently.
So, what happened? To really understand that drop, we have to look at the numbers. And there are really two key parts to this: what they did last quarter and what they said they're going to do this year.
Okay, so let's start with the good news. For the fourth quarter, Dominion posted adjusted earnings per share of 68 cents. Pretty solid.
In fact, that was a beat. It came in 1 penny ahead of what Wall Street was expecting. And it wasn't just earnings. Their revenue also beat estimates by more than $370 million. So far, so good, right?
So if the quarter was actually pretty decent, what was the problem? What spooked everybody? Well, it all came down to one thing: guidance.
And this right here is the smoking gun. This is what caused all the trouble. When Dominion gave its forecast for 2026 earnings, the midpoint came in at $3.57. The problem? Wall Street was expecting $3.60. We are talking about a 3-cent miss, and in this market, that's all it takes.
But despite that slight guidance miss, management tried to get everyone to focus on something much, much bigger: their long-term vision.
And the centerpiece of that vision is this: a truly massive $64.7 billion capital spending plan for the next 5 years. To put that in perspective, that's almost a 30% jump from their last forecast. Huge! And where is all that money going? It's pretty much all about one thing: data centers. The demand, especially in Virginia, is just exploding because of the AI boom, and Dominion is scrambling to keep up. They're so confident in this, they're sticking to their long-term growth targets and even hinted that growth could speed up toward the end of the decade.
The CEO, Bob Blue, really hammered this point home. He said, look, this isn't just some pie-in-the-sky forecast. This is based on actual, signed contracts that already cover the demand they expect for the next 20 years. Okay, so if the long-term story is so incredible, why all the skepticism? Well, the market isn't looking 10 or 20 years out. It's looking at right now, and it sees the costs and the risks of paying for all that growth.
The CFO actually laid out the problem very clearly. He basically said, even with our asset base growing 10%, our earnings per share growth will be lower, and there are 3 reasons why. 1, they have to issue new stock to help pay for everything, which dilutes existing shareholders. 2, borrowing money is more expensive now with higher interest rates. And 3, you're spending all this cash now on giant projects that won't really start making big money until way out in the early 2030s. That gap is what has investors worried.
It's also worth remembering this context. Leading into this earnings call, Dominion stock had been on a tear, crushing its peers. So part of the negative reaction was likely just good old-fashioned profit-taking. The stock had run hot, and the guidance miss was the perfect excuse to sell.
So, let's bring it all home. Where does all this leave us as investors? Let's put it all together and make the call. What you have here are 2 completely different stories fighting for control. The bull case is simple. This is the best way to invest in the AI electricity boom, and the growth is basically guaranteed. The bear case is also simple. That's a great story, but the short-term costs are real. It's a show-me story now. They have to prove they can pull it off.
So here's our call. We expect the next quarter to be pretty straightforward, no big surprises. All eyes will really be on their big offshore wind project. Because of that show-me status, we think the stock is going to be stuck in a range for a while. It needs to prove it can execute on this massive spending plan before Wall Street gives it a higher valuation. So for now, we are initiating coverage with a market perform rating. This is not financial advice.